So is there anything for like just regular investors to worry about? I know you're saying that this is going to affect brokers and
Well, why don't we see over here on on the dark pools? Let's just see. Go to this cboe.com site, and we can see today the percent of trades through dark pools for today.
you want me to hit all the buttons?
Hit hit all the buttons, or you could just hit the ADF button. So the ADF button is the one button that we know is the NASD ADF, that is dark pools. The other one is the FINRA NASDAQ TRF Carter DQ. That's the regular market that has the other points. So when we look at that, you can see that today dark pool trades consisted of 43.95% of all trades. And right below that, the regular market, 35.4%
Oh
through
my
exchanges.
goodness.
So, and we could also look back in January. You know, you look back in January 1st, January 2001, I mean 2021. In January, you can see that that's when dark pools started seeing the most activity.
Yeah, that's a
You know,
spike.
starting at December 24th onward, all throughout January, it was at its high with its peak on February 9th as well. So regular investors, you're seeing that retail investors, we don't have as much insight into the market. When the SEC gets this information, they're supposed to supply this data to the retail investors because we are supposed to be playing on a free market as well. But it's also better that they get the information first so that they're able to see the manipulation in the market firsthand. And with every broker dealer being tagged and market maker having a unique ID, that's going to show who did it, who made the actions, and that's going to give more information. Another cool site is the stockgrid.io, which gives the short volume of well, we can see the short volume if we look into it and look up the ticker GME. You can see that through dark pool activity, 54.39% was short volume. So, and guess what? Today, the total volume, including the dark pools and everything, was at the year-to-date lowest volume we've had at 2.4 million shares just traded. That's super low. The average volume right now is 9 million. So we should see some more activity, as in the prior past, whenever there is a very low day of trading, the next couple of days were very active. So we should see a nice run within the next 9 to 13 trading days, because that's just how the pattern's been going, you know. But take it as you will.
Interesting. So it looks like GME, AMC, it looks like they're both taking off. In the last time that GME sprouted, and sprouted they did. What was the who came first? Was it AMC then GME, or was there any type of pattern in how these stocks are jumping?
You know, when we look at the two charts, you can see that they both were in tandem. They both were very correlated until recently, where AMC started going off more than GME, and that's what happens when they know their main problem is GME because of the over shorted, and we saw 226% on January 15th short interest of GME. If I was a large firm, I would rather let AMC go, cover my position for GME, and try to figure out a way to get out of that tough spot. You know, they're trying as hard as they can, and AMC seems like the one that they're gonna let loose first, the wild Mustang, and it's gonna roam free first. That's what I predict. And then once they lose all that capital, and they're not able to cover their short positions and they don't have enough collateral, then GME is going to start taking off. And speaking of recent European, not European, speaking of recent investors and investment brokers, a European investment broker, T212, they have started notifying general investors that if they don't provide consent before July 13th about the investors being able to lend their shares to shorters, then their account will be limited to closing or just reducing positions only. So that's an interesting take. They look like they could be the next Robinhood, but they're pretty much just saying, hey, we want to lend your shares, and if you don't give us consent before July 13th, 2021, then we're just going to restrict your trading. You're just going to hold whatever's in your account. We're just going to leave it there. You're only going to be able to close your positions or reduce your positions, and it's just going to be nothing but just something you'll look at your screen for, which is sad, because how can, in a free market, brokers begin to limit their investors of what to invest in? So that's another interesting tidbit there.
Sounds like a conflict of interest when it comes to like investors not investing what their the capital that people want them to invest in, right? Is it conflict of interest?
Well, it's more of, I would say it's, I don't know, neglect to what a broker actually is supposed to be, and negligence, because they're supposed to be there for the people. Yet they know that GME is a very, very risky stock right now, and they want to start lending out your shares because they and do a quick spin on it and say, well, we make a moderate profit through lending your shares out and gaining interest, and that's what we want to do. Well, investors should have the voice to say, hey, we don't want to lend out our shares. This is ours, and we don't need to do that.
Right. If you can legally ask for your property to not be lended, it's you asking people to allow that to happen, else you have restricted access to the market, is like saying it's your right to do this, but if you do this, we'll punish you. So in a way, it's kind of like skirting legality and kind of giving you that, kind of putting you in the corner and saying, like, you can do this, but we'll punish you for it. And as a result of that, I think that you're just going to get sued. I think that's stupid, and I think they deserve to be sued because they don't have the right. You don't have the right to do that to people, to restrict free market access because they don't do what you want them to do, because you perceive they're not giving you enough liquidity, when it's their right to deny you the ability to provide that service because it's using something that they own as opposed to something that the brokerage owns. They can short all they want if the brokerage wants to own the shares, but they won't because they have to stay delta neutral and they don't want to own any positions. So it puts them in a tough spot. It limits their clientele, but their purpose is to be there for the betterment of the investors and to keep money moving, especially as a market maker and as a fund for themselves second.
So
Exactly.
should investors be worried about going in with these brokers, or what's kind of the
definitely.
warning or takeaway?
I think that a lot of people, there are a lot of brokerages out there, and everybody wants to use the kind of a new hip one that gives you free this, free that. I think that your best bet is to stick with some of the bigger traditional brokers like Fidelity and TD Ameritrade, Interactive Brokers, right? These guys are big, these guys are strong, they have lots of money, they give you commission-free trades. I think if you keep sticking out with these little guys, that it's advantageous for them to want to allow as much position taking as possible in both directions to bring in commissions for themselves and put themselves on the radar. So if Fidelity came to me and told me that I wasn't allowed to do something with my property, and if I decided to do it, then they would restrict me, I would pull my money out immediately and go to another brokerage, because that's the glorious part of having a free market society, is if they don't want to do it, fine, you'll find somebody else, because there's many other brokerages out there. So whoever that is, the T22, whatever it is, to hell with you.
T212, yeah,
Straight,
exactly.
empty your accounts and go somewhere else. Like, who gives a shit about these
It's
people?
like you
They're
buy
just
an
one more
Xbox.
loser brokerage in the world.
Yeah, you buy an Xbox, it's right there. You're not using it. Someone comes over and says, "Hey, I'm going to lend this out just because it's just sitting there. And this is your property, but I'm going to lend it out and gain some interest off of it." And you're just like, "Wait, this is my property." So,
right, because I understand, and it's not because remember, stocks aren't the same as cash and normal capital, right? Where a bank lends out your money in the form of loans. Like, you lending out a share is not the same as you lending out some form of cash to do as an investment. You lending out those shares is just so somebody else can take a different position. And as we know, as we've seen over and over again in the last couple of months, is that people are using these shorts and kind of they're getting washed out in the market in these huge positions, and they're getting lost. And that puts it at a loss for not only for the firm, but for you as an investor, because that's your technical share. And when you want to cash out, you might have problems with fail to deliver from your brokerage. You may have inabilities to get your asset when you wanted to, because again, it's not the same thing as normal capital. And I think that what they're doing is stupid.
It kind of sounds like a desperate move on their end. Are they trying to cover their own?
I don't know what
liquidity?
angle they're coming at.
It just sounds like they really want to get involved in it, and they don't like that a lot of people on theirs are saying no. And that's tough, because when investors have rights, and you're not skirting the rights and telling them no they can't, but you're putting them in a position that says, like, do this or else. I don't know, unless their plan is to get people to leave, in which case they free up more capital for other investors and try to flush out the ones who are holding and get new investors that won't want to hold and will allow them to short.
I mean,
again,
I don't even know why they would even want to short people's shares, because
a client wants to short for them. So if a client wants to do a short position, that just brings more money in commissions, and as a middleman, that more activity brings me more capital. So if I get a bunch of people that say we want to short, and I got a bunch of people who won't let me short, well, that causes me a problem, because there's a market. There are people telling me I'm willing to give money to you, and I can't get it because nobody lets me short their shares. So there might just be a huge demand for a short position, and this company's like, well, fuck it, based on our odds, we could actually make a lot of money doing this, so it's worth the risk to our customer relations.
But I don't think they understand the risk. They don't understand the risk that if the customer that is shorting and GME goes and blasts off to the moon, and the customer isn't able to cover their position, then guess who's on the hook? The broker dealer is on the hook. So they're looking at more this money aspect, and they're not looking at the risk factor, because other brokerages now have GME at, if you're taking a long position, it has to be 100% of margin. If you're taking a short position, it has to be 300% of margin. So you need to be able to cover your short position, and that's these other brokers that I've seen recently put up their numbers for collateral for margin.
Okay.
Well, maybe they're being backed by somebody that has a lot of capital, and that's why they want to do it.
And before we go on break, I'm just going to touch on the reverse repo rate getting on at a new time high of $841.24 billion. So overnight reverse repos, new high. Congratulations.
The Fed's
$841 billion.
You should note the Fed's balance sheet is up above, I know, $8 trillion now. So, when you think about it, that's just $8 trillion liquidity that the Fed has been pumping into the markets. And you just think about, we have a big thing in this country about cracking down on entitlement programs, which I agree with, because entitlements are going to fucking crush us going forward because we can't afford any of it. But I always find it interesting that everyone always attacks the handouts to the everyday middle class, but the government's handing out just money. They can't make money fast enough to hand it out to big banks and businesses, and those are okay. Those are for the longevity of our market, which when you look at COVID and you see the steep drop of 33%, when you look at the behavior of the overall market, that was only classified as a bear market because it technically fell far enough to be classified as a bear market. But when you look at the rebound, you're actually seeing more momentum on the way back up. You're seeing that bigger companies didn't do worse on the way up. Like, there wasn't a reshuffling of power as you normally have out of a bear market. There were big companies that continued to do well coming out of this bear market, which is not how these things are supposed to work. So what you're really seeing is just like an extension of strength. And I think that we have significantly overplayed our hand in giving money to the economy because we were so scared. And the only way we know how to solve problems anymore is
It's
by
throwing
debt
money at it.
financing. And
Yeah.
I think that we are causing a problem, not like maybe necessarily an inflation in the short term or pain in the markets, because I think this is the longest bull market we've ever fucking been on, and for a very
Mhm.
long time. But I think the problem is in the long term when all this has to come back down and we have to deal with it in the future. And I think that the federal government, I think they really um,
They're
need to do
they
something better.
they need to
This is
bring
ridiculous.
this in because $841 loan from the banks to the Fed, and they give that back the next day, and the Fed gives them interest of 5 basis points. That's equivalent to right now over $400 million. They're giving in excess back to the banks.
Right.
The U.S. Treasury rate, the 1 month, 2 month, 3 month maturities of Treasury bonds is 4 basis points. The overnight reverse repo, 5 basis points. You know how absurd that is?
It's
That's absurd.
ridiculous.
They are trying to say, hey, don't go to these regular treasuries. We don't want you to. You don't need to wait that long. You don't need a month, 2 month, 3 months to wait to get your 4 basis points, 5 basis points. Instead, you
Right.
could do it overnight, and
And
get the 5 basis points overnight. And it's
And the
just
crazy part is that all that money the banks get, they're just giving it back to their shareholders, doing buyback, increasing their dividend. They're just increasing the value of their own business. They're getting
mm-hmm,
free money from the Fed, 4 basis points higher than the banks are willing to give anybody holding a savings account. And they're going to pump all that money back to the investors. If you're a client of a bank, you don't benefit unless you're a wealthy investor. One lesson to
exactly.
learn is that the only way you're going to make money as a retail investor, the only way you can be able to do that is if you structure some very long-term, Roth IRA thing and an employer contributions to 401ks and build some ridiculously big portfolio, or you're gonna be able to play in the market. So it's ever more imperative that we make free markets because there isn't any way to make return. Banks are a terrible. I honestly don't think you need to save your money there. You can use your brokers as dealers. I was making more return from keeping my
More
money in
interest.
Fidelity as
Yeah,
interest. You make more interest holding crypto coins on Coinbase than you do at a bank that actually has so much money that it literally could survive a halving of the stock market and twice as backstopped as it needs to be. So I mean, I don't understand. I just
it's
I don't
a
understand.
crooked market. It's 2008 all over again. Instead of the government directly bailing out the banks, they're now giving them a stimulus check every day, the next day,
And they
of
just keep going,
millions
and they're
and
gonna keep
millions of
doing it for
dollars.
years.
That
Yep,
does not sound
I don't.
fair at all.
it's not fair.
No,
And
but then we have our deficits and we don't have money to spend on things. And they're like, oh, it's tough. We got to tighten the belt. It's like, yeah, but all these big bloated companies and funds and banks that you just kept raining money on because you were scared that the economy is red hot. People are spending it. I don't know what the Fed is like looking at this market saying like, we need to support it. To support it, we stupid. It's just the government botched the government botched in every way, shape, and form their management of COVID, and they're botching the after effects. And
mhm,
even though inflation may prove to be transitory and things may go back to normal, the amount of debt, the deficit spending, the gaps in wealth, the gaps in trust of the system, all of these things are huge amounts of damage, and the lack of regulatory effort has just been abysmal. So they just
yeah,
need to, I don't know, they need to do better. I mean, it's not for me to say what they should do, but then again, I don't work there for 30, 40 years, and I haven't trained, and I don't get paid the money that these people get paid to do these jobs, and it's not my
exactly.
responsibility. But I know that I don't need to be a mechanic to know if my car doesn't run properly. So I don't need to be an official in the Fed to know that the Fed, the SEC, that these people need to, you know, just they need to do better. They just need to do a better job. This is
And
ridiculous.
when we get
Free money.
back from our commercial break, we're going to talk about political figures that I believe are doing ethical violations and huge conflicts of interest.